Hey there, and welcome to the deep dive. Today, we're digging into Lemon Tree Hotels Ltd. Got a whole stack of documents here. There's a company filing on board decisions, the full financial results, and, a big investor presentation. It all covers their Q4 and the full financial year ending March 31st, 2025. So our job, basically, cut through it all, pull out the key numbers, what's happening operationally, their strategy, and, what it all means.
Exactly. And these docs, they were just filed May 29th, 2025, right after a board meeting. So it's really fresh info on where they stand and where they're pointed. We'll kind of guide you through it, point out the important bits, and try to connect the dots.
Right. So settle in. Let's get you up to speed quickly. Okay. Let's unpack this. Right. First things first. The big financial headlines. The investor presentation doesn't mess around, does it? Straight up declares best ever Q4 and best ever FY. Bold.
It is bold, yeah.
Yeah, fair.
But the consolidated numbers, they seem to back it up. For Q4 FY25, total revenue hit, ours 379.4 crore. That's up 15% for the same time last year. And net EBITDA, well, that was even stronger. Ours 205.0 crore, up 17% year over year. And just, for everyone listening, EBITDA, that's earnings before interest, taxes, depreciation, and amortization. It kind of shows you the core operating profitability.
Got it. Okay. So profitability relative to revenue. How did the margin look?
Good question. The net EBITDA margin for Q4 was 54.0%. That's up 109 basis points compared to last year. So a basis point is just 0.01%, meaning a bit over a 1% point margin improvement. Pretty solid. And profit after tax beat that jump quite a bit, up 29% year over year to Rs 108.1 crore. Cash profit also grew nicely, 22% year over year, landing at Rs 143.0 crore for the quarter.
So a strong end to the year. How did the full year shape up then?
Full year FY25 total revenue was Rs 1288.4 crore. That's a 20% jump from the year before. Net EBITDA also up 20% to Rs 636.5 crore. The margin for the full year came in at 49.4%. That's a slight increase, about 28 basis points year over year.
Okay.
Full year PT, Rs 243.1 crore, up a really substantial 34%. Cash profit, Rs 382.4 crore, up 30%. And earnings per share, EPS, grew 32% to Rs 2.48.
Interesting. The full year growth rates seem in many cases a bit higher than just Q4, suggests they really built momentum through the year, right?
Yeah, it does look that way.
And you mentioned the auditors, Deloitte. They gave it a clean bill of health and unmodified opinion. That adds some weight.
Absolutely. Standard procedure, but important confirmation.
Okay, so those are the big financial figures. But what was actually happening in the hotels? Let's look at the operations for the ones they own and lease.
All right, this is where you see how they got those numbers. In Q4 FY25, for their owned and leased hotels, the gross average room rate, ARR, was Rs 7,042. That's up 7% year over year. But the big mover was occupancy. It hit 77.6%. That's a jump of 557 basis points compared to last year's Q4. Huge increase.
Wow, so getting higher prices and the hotels are much fuller.
Exactly. And when you combine those two, price and occupancy, you get RevPAR, revenue per available room. For Q4, RevPAR was Rs 5,462. That surged 15% year over year.
Okay.
So higher rates, much higher occupancy. That's your revenue growth story right there.
Makes sense. And the presentation, it digs deeper, right? Looks at performance by brand and region for their main owned hotels.
Yeah, they break it down for a core set of 41 owned properties. And yes, some brands and locations really stood out in Q4 FY25 versus the year before. In terms of RevPAR and hotel-level EBITDA per room growth, their upscale brand Eureka saw a 25% jump in RevPAR and an even bigger 38% growth in EBITDA per room. Red Fox, that's one of their economy brands, also did really well. RevPAR up 20%, EBITDA per room up 21%, and Keys, their mid-scale brand, RevPAR up 24%, EBITDA per room climbing 26%. So strong performance across different segments.
And any particular cities or regions driving that?
Yeah, definitely. Some major markets showed really strong growth. Mumbai had RevPAR growth of 20%, but a massive 38% jump in EBITDA per room.
Wow.
Bengaluru was also impressive. RevPAR up 23%, EBITDA per room of 37%. Delhi contributed solidly too. RevPAR up 17%, EBITDA per room up 23%.
And the filing mentioned that huge Aurika in Mumbai opening back in October 23, right? The 669 room one. That must have played a big part in the Mumbai number.
Absolutely. That would have a significant impact. Oh, and the presentation also showed the split between negotiated bookings in corporate contracts and non-negotiated, which is more your retail or individual travelers. That mix, how many nights and how much revenue came from each, it stayed pretty stable between FY24 and FY25.
Right. And why does that stability matter? Or does it?
Well, it's interesting because often that non-negotiated, the retail side, can have higher margins. So while stability isn't bad, the company later talks about wanting to increase their retail share. It suggests they see an opportunity there, probably to boost margins further by getting more direct bookings, maybe through their loyalty program or website upgrades they mentioned.
Oh, okay. Makes sense.
Now, flipping over to the cost side of things, expenses went up, obviously, with more business. But how did they manage costs as a percentage of revenue?
Yeah, good question.
Well, in Q4 FY25 versus Q4 last year, key costs like payroll, food and bev, power and fuel, they all actually decreased slightly as a percentage of revenue. For the full year, most costs were pretty stable or slightly down percentage-wise too. Payroll and other expenses did tick up just a tiny bit as a percentage, though.
Okay. But I did spot one cost line that went up noticeably percentage-wise. Renovation expenses.
Good catch. Yeah, that's definitely highlighted in the commentary in the charts. Renovation costs rose to 2.7% of revenue in FY25, up from 2.4% the year before.
And what's their explanation for that?
They basically said it's a deliberate, increased investment in sprucing up their owned hotels. And they expect this higher spending level to continue into FY26. The plan is to then bring it back down to around 1.5% of revenue once the main renovations are done.
Okay.
The idea, they say, is that this investment helps maintain quality, which supports rates, and ultimately helps stabilize that EBITDA margin near their 50% target long term.
Right. So it's like a short-term dip in margin percentage for a longer-term gain. Invest now, basically.
Exactly. Investing now for future returns.
Speaking of the future, a huge part of their strategy is this asset-light model. How's that side of the business doing?
Yeah, this is clearly a major focus. So besides their own hotels, they get fees for managing or franchising hotels that other people own.
Sure.
And the documents show this is a really significant and growing income stream. Total management fees in Q4 FY25 are 44.4 crore. That's up 16% year over year. And for the whole of FY25, those fees hit Rs 148.9 crore, up 22% from FY24. So strong growth there. The investor deck also uses this broader term, hotel network revenue, which is basically the total revenue generated across all their hotels owned, managed, franchised before they take out their fees.
Right.
And that total network revenue grew 17% year over year in Q4 and 21% year over year for the full year. Importantly, both their own hotels and the managed franchised ones contributed strongly to that growth. So the whole network's performing well, not just the hotels they own outright.
So the network's growing, and it seems like mostly through managing or franchising for others now. What about new hotel openings or signings recently?
Yeah, good point. In Q4 FY25 itself, they actually opened 2 managed franchise hotels, added 121 rooms to the operational count. But maybe even more telling for the future is the number of new contracts they signed in Q4.
Yeah.
15 new deals, management and franchise agreements. That adds another 833 rooms to their pipeline.
Wow, 15 in one quarter.
Yeah. With openings expected anywhere from FY26 out to FY29. Across different brands, different places, lots of activity.
So what's the big picture then? Total hotels, total rooms?
Okay, so as of March 31st, 2025, the grand total is 212 hotels and 17,116 rooms. That includes everything operational and in the pipeline. If you break it down, 111 hotels are currently operational with 10,269 rooms. And then there are 101 hotels in the pipeline, representing another 6,847 rooms.
And that pipeline, is that mostly asset light?
Overwhelmingly, out of those 101 pipeline hotels, 99 are set to be managed or franchised.
99 out of 101, okay.
Yeah, so that really hammers home where the future growth engine is. It's clearly the asset-light strategy.
Which presumably helps their balance sheet too, right? Less capital needed up front compared to owning.
Exactly right. Which is a nice segue to their financial position. Debt reduction was a big highlight in the commentary.
Right. Tell us about that.
Okay, so the numbers show their total debt dropped by Rs 190 crore during FY25. It went from Rs 1889 crore down to Rs 1699 crore by the end of March 25.
Okay. Decent chunk.
Yeah, and that reduction really improved a key financial health metric, the debt-to-net EBITDA ratio. That ratio fell from 3.57 times in FY24 down to 2.67 times in FY25. That's a 25% drop in that leverage ratio. Big improvement. And their cost of borrowing also nudged down slightly.
And just quickly, for anyone listening, why is a lower debt ratio a good thing?
Well, fundamentally, it means less financial risk for the company. Lower debt usually means lower interest payments, which helps profits. And it gives them more financial flexibility, more breathing room, which is really important for a company like Lemon Tree that's in growth mode.
Right.
A stronger balance sheet just means they're better positioned to fund future growth, whether it's those couple of owned projects they still have, or more likely supporting the expansion of that big asset-light portfolio.
Got it. And their cash position improved too, you said.
Yes, cash and cash equivalents also increased in FY25, adding to that picture of better financial health.
Okay, so all this activity, the performance, the finances, the expansion, it all fits into this broader strategy they call Amentree 2.0, right? Covering CY24 to CY28. What are the main goals there?
Yeah, they've laid out this roadmap with some pretty clear targets. First, they want a stable 50% EBITDA margin and a 20% return on capital employed, ROCE. ROCE basically shows how well they're using all their capital, debt, and equity to make profits. So 20% is a pretty ambitious target for efficiency.
Okay, 50% margin, 20% ROCE. What else?
They aim to be the dominant mid-market hotel leader, target over 20,000 rooms in the network. And critically, they want over 70% of that network to be asset-light, really doubling down there. And they want to lead in urban supply in their segments.
Makes sense.
Financially, the goal is a strong balance sheet, aiming eventually to be debt-free with lots of free cash flow. And finally, they're targeting leadership in digital stuff and ESG, environmental, social governance. Things like cutting energy use, diversity, good governance practices.
So how are they doing against those big goals based on what the presentation shows?
Well, they seem to be moving fast on a few fronts. Inventory, for instance. They hit 17,116 rooms by March 25. That's already 85% of the way to their 20,000 plus target. And they actually state they expect to blow past 20,000 rooms during FY26.
Yeah.
They'll be 3 years ahead of their CY28 plan.
Wow, okay. Ahead of schedule there.
Yeah. EBITDA margin at 49.4% for FY25 is already super close to the 50% goal. Although, like we said, that renovation spending might keep it just under for a bit.
Right.
Debt reduction obviously made big strides towards the debt-free goal in FY25. The area where there seems to be more work needed is that retail demand share. They were at 45% in FY25, but the target is 66% by CY28.
So quite a gap still.
Yeah, which is probably why they're pushing things like the revamped loyalty program, Infinity 2.0, and website upgrades. They need to drive more of those direct, higher-margin retail bookings.
And they touched on ESG too.
Briefly. They mentioned specific targets for FY26 compared to an FY19 baseline, things like cutting energy and water use, using more renewables, green building certifications, workforce diversity, and they showed progress made in FY24 towards those.
Okay. Now, just before we wrap up, that initial filing from the board meeting, it mentioned some other decisions too, right? Appointments and things.
Yes, standard board business, but still relevant. They appointed new secretarial auditors, DPV and Associates, for 5 years, subject to shareholder, reappointed their internal auditors. But more interestingly, some key people changes. Mr. Pawan Kumar Kumwat is the new company's Secretary and Compliance Officer, effective immediately. Lots of governance experience noted.
Okay.
Mr. Vishvapreet Singh Chima is coming in as president from June 9th. Long background in hotel operations. And Mr. Saurav Shadal is joining August 1st as a senior manager and also CEO of their subsidiary, Fleur Hotels. He's got a background in consulting and deals in hospitality.
New leadership in key spots.
Exactly. And they also extended some existing shareholder agreement.
So, yeah, maybe routine stuff for a board, but these are the people and structures that need to execute the strategy we've been talking about.
Precisely.
Okay, so let's try and pull this all together. What have we learned from this deep dive? Lemon Tree Hotels definitely had a strong Q4 and FY25 financially. Revenue, EBITDA, profit all up significantly, driven by, well, getting better room rates and having much fuller hotels.
Yep. And they are clearly pushing hard on expansion, but the focus is very much on that asset-light, managed and franchised model now. That's where the pipeline growth is. And financially, they're actively working to de-risk the business by paying down debt quite aggressively. The balance sheet looks stronger.
So by going through these documents, you, the listener, should now have a pretty solid handle on their recent performance, what's driving it, their big strategic goals under Lemon Tree 2.0, and even some of the key people involved, all straight from the source.
Right. And maybe here's something to chew on as we finish up, something that comes out of all this. They're clearly confident and way ahead on their room count target. So, how quickly can they really blow past that 20,000 room mark? And at the same time, will that investment in renovations, which is hitting margins a bit now combined with that push for more retail bookings, will that be enough to get the EBITDA margin sustainably to that 50% target, or maybe even push beyond it in the next few years? That seems to be the key tension, right? Growth versus margin optimization.
Definitely something to watch. Thanks for joining us for this deep dive.